Good morning. Today we're going to look at the partnership accounts, those general ledger accounts unique to partnerships. We're looking at this question and specifically 3.1.2, the appropriation account. But we're going to expand it a bit and not only do the appropriation, we're going to use this information and do all the different accounts that's unique to partnerships. So firstly, the information is as with every general ledger account we have to post, we must put in the opening balances. Capital or increases on the credit side, similar to a liability, so their balances will be on the credit side. So Capital West 1.5, so we will go to Capital West on the credit side. It is 2000, let's just make sure what the date is. 1st of March 2011. So it's 2011 March and the day will be the 1st of March. Okay, let's just March the 1st. Okay, let's see, March 2011 and it's the 1st. Good, and it is balance brought down and the amount was 1.5 million. 1.5 million. The same with Reach. March 2011. The first balance brought down and his was 2 million. 2 million. Let's make that one also a bit clearer. Good. Next balance, the drawings. Drawings reduces the owner's equity, so it will be on the debit side. So West 950 and Reach 970. So go to drawings, West, March 2011, the first. Make that one a bit bigger. And it is balance brought down. And his was 950,000 and Reach 2011. The first balance brought down and his was 970,000. Next balance, the current accounts. Current account can either be debit or credit. This is the account where we record whatever the partner is entitled to take and what he actually took out. So if he took out more than what is entitled, he will end on a debit balance. If he took out less, he will end on a credit balance. So West had a credit balance of 250,000. So credit March 2011, the first balance brought down, and we said he had a balance of 250,000. Rich had a debit balance. The first balance brought down, and his balance was 300,000. So we've got all the balances in. Now we can go and look at the information. They're normally going to give us some information about especially what they're entitled to, which can be interest on their capital, their salaries, and a bonus. So in this activity, they've got they're entitled to all the different types of things that they can be. But the first thing has to do with their capital. Now they say on the 1st of September 2014, the partners, okay, there's a mistake. that would be 2014. Okay, the 1st of September 2014, the partners equalized their capital contribution. So what it means is West at 1.5, he must get it up to 1.75 million. So he must put in a further 250,000. Rich had too much, he had 2 million, so he must take out 250,000 to get it down to 1750. So what they must do is each must adjust whatever they've got in there to equal 1,750,000. So if we look at West, just make sure these ones are now 2014 because else it won't make sense. 2014, and the drawings down there, and their current accounts. Good, so he had to make his more, and it happened on the September the 1st. Make sure September the 1st, and he had to put in more money. If we put it in, it means we're going to put it in the bank. So the opposite account will be bank. It's a CRJ, and it's 250,000. We now balance his account, add to 1,750,000, which means that side must also be 1,750,000, which means his new balance is 1,750,000, and that would be February 2014. February 2015, sorry. The end of our year, the 28th. The 28th balance carry down 1,750,000, and next year, which is March 1st, 2015, the first balance brought down 1,750,000. So his has now been adjusted on the 1st of September. Rich, however, must take out some money also on the 1st of September. Take out means we're going to give him a check, pay it out of our account, which is a CPJ. So September 2014, the first opposite account bank on the CPJ, 250,000. We now balance his account. That side is the biggest, so the total is 2 million, which means that side must also be 2 million. Difference between the 2 and 1,250,000 is 1,750,000, and that would become on February 2015, the 28th, he will have a balance carry down of 1,750,000, which means next year, March 2015, the first is going to start off with a balance brought down of 1,750,000. So now you can see their balances are the same, both 1,750,000, and that is what the instruction said. Okay, number 2, provide for interest on capital. Take into account the adjustments in the capital contribution, these things that we just did. They give me West is 195, I must do Ridges. They tell me to show the calculations. So let's go to our general ledger and calculate the interest. Go to interest. Okay, so the one that we must actually calculate is ridges. So for ridge, because they give me Wests. Ridge, what amount did he have in capital on the first day of the year? On the first day of the year, he had 2 million. See, March the 1st, he had 2 million. Let's just get back there. So on March the 1st, he had 2 million. But it increased or decreased it on September the 1st down to 1,750,000. So be careful now. He had 1 million from the 1st of March till the 1st of September. On that, he's going to get interest. Then from the 1st of September till the end of our year, which was 28 February, he reduced it to 1.75. So I must work out the interest for that part of the year on 2 million and for the second part on 1,750,000. Now, so from the 1st of March till the 1st of September, it's March, April, May, June, July, August. We cannot include September because he only decreased it on the first day. So it is 6 months that he had 2 million. And then for the second period from 1st September till the end of the year, he had 1.75 million. So again, then should be 6 months. It's September, October, November, December, January, February. So another 6 months. Good. So in the next part, we will do the actual calculation.